Hello, welcome to this evening's webinar, Investing Like a Stock Superstar, led by Wayne Thorp. I'm Kyler Worth, and I just want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor. Thus, we are not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you to make better decisions. A handout of the presentation is available under the Handouts panel of your GoToWebinar control panel located on the right-hand side of the screen. If you have questions for our speaker, please submit them using the Questions panel of your GoToWebinar control panel. Our moderator will select questions submitted and read them aloud for the benefit of all watching the broadcast. Questions that are not selected for the broadcast will be reviewed and addressed afterwards. If you experience any issues with audio or video of the webinar, please consult the instructions on how to change your device's settings or consult the GoToWebinar website for support. That's www.gotowebinar.com. A replay of the presentation will be available tomorrow on AAII's YouTube channel, along with the links to this evening's handouts and to some of the resources discussed. These links will be sent to your email address. Links to some of the resources discussed will be sent to your email address tomorrow. AAII's mission statement. The American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. Now, please sit back, relax, and enjoy this live presentation. Take it away, John and Wayne.
Thank you very much, Kyler, and welcome tonight to our special presentation on investing like a stock superstar. I'm John Bykowski. I'm president of the American Association, and I have a very special guest tonight, Wayne Thorp. Welcome, Wayne.
Hello, John. How are you?
Very good, thank you. Now Wayne, we were chatting a little bit before tonight's presentation, and you've been at the association now for over 24 years, and you were at the launch of the Stock Superstars report. But even more importantly, as you took over the service, last year you did a major refresh of the service, and you've been running it like clockwork ever since. So it's a pleasure to have you aboard. And I guess beyond the lead manager and editor of the Stock Superstars report, you play many roles at the association. Why don't you tell the audience a little bit about what else you do at the association?
Well, I also am overseeing new product development at the association, and overseeing and helping to enhance and improve upon our existing products. Stock Superstars report, our VMQ stocks, our dividend investing newsletters, working with Charles Rotblatt and Derek Hageman in ways in which we can improving those services, as well as heavily involved in the development and ongoing improvement of our A+ online service, as well as our Stock Investor Pro fundamental stock screening and research program.
Well, that's quite a bit there, and I know you put your heart into it all, and we all benefit from your effort. I'm really looking forward to tonight's presentation. I know that, like you, I mean, over the years we've analyzed the techniques of many guru investors, many superstars, and I find it very interesting because it's a chance to get into the mind of how successful investors have done and the techniques they use. And I mean, anything in particular you want to point out before we get started tonight?
Well, I mean, I totally agree with you. You alluded to the fact we did a refresh of SSR last year, and part of that I read, several books related to the four gurus that I'll be talking about this evening, and it's what I found fascinating was, when I first, I've been involved with SSR now for almost 20 years, probably read these books multiple times over the last 20 years, and it's always fascinating to me how, as I have grown and changed as an investor, my interpretation changes a little bit, and I always pick up these new nuggets. And it's just, it's just fascinating to me how, a lot of people think that investing is this complicated thing, and it's, at the end of the day, it's really as complicated as you want it to be. But just reading through some of these books and understanding the strategies, this isn't rocket science. Many of these things are so, fundamental, and just like you're like, wow, it's really not that complicated. And that's what always I come back to is, you can be very successful as an investor, and you don't have to make it overly complicated.
It's true, and there are many techniques that have been shown to work. I think the key and why reading what these gurus have done, I think too often we put a lot of emphasis on just finding good ideas, but really it's important on the sell as well, and it's important to understand the factors that go into why you buy a security and what impact those factors might have when it comes time to sell. And I think one of the challenges we all face is we seem to really think carefully about our buys, but we don't think quite as carefully or discuss the pros and cons of selling. And hoping you'll cover some of that tonight. And
absolutely.
Again, just as a reminder to our audience, we are recording tonight's presentation. A email will go out tomorrow with a link to for you to be able to see it. We have Jean, our managing editor, out there. I'm sure she's taking great notes down, and she'll be sure to include any kind of links that are mentioned tonight. And knowing Wayne probably has a couple of links embedded in his presentations as well. So with that, I think, Wayne, you're going to typically primarily hold questions till the end, but you'll leave plenty of time for Q&A. But if you have any questions, just type them into the questions area, and I'll be looking for them and pass them on to Wayne when it's appropriate. Take it away, Wayne.
Thank you very much, John, and welcome everyone. Well, have a good evening, and welcome to tonight's AI Webinar Wednesday, where I'll be giving you an overview of the Stock Superstars report. Tonight, my goal is to provide a broad overview of the 4 strategies that we use to manage the Stock Superstars report portfolio, as well as at the end hopefully, barring any technological issues, be doing a sort of a live demo of the SSR website and some of the resources that subscribers have access to. As John said, I normally hold questions to the end, but John will be looking at these questions as they come in and answering them at the end. So I encourage you to submit your questions through the GoToWebinar dashboard. So as John mentioned, I've been with the association now for over 24 years, and actually on April 1st, 1997, my very first day at the association, John Bajkowski, who's been my manager and mentor for these many, many years, gave me a disc of our Stock Investor Pro stock screening software and told me to become intimately familiar with his software, which I have, now being the program manager. But from day one at AAII, I've been involved with quantitative stock screening. And over my 20 years, I've been involved with developing and reviewing a number of quantitative stock screening strategies. And through that analysis, both on my own as well as the analysis that we've done at the association, we've come across several strategies based on the investment methodologies of both professional money managers as well as academics that have outperformed the overall market on a long-term basis. And over time, we've come to call these individuals stock superstars. And 4 that I'll be talking about this evening are Jim O'Shaughnessy, William O'Neill, David Dreman, and John Neff. And the Stock Superstars report grew out of all of the data. We track over 60 different stock screening strategies. We have back-tested performance data going back to the start of 1998 for the vast majority of these methodologies. And we looked through these methodologies and we identified several strategies that performed well over the long term. But even more importantly than that is these are strategies that are understandable as well as investable, meaning that they generate a large enough universe of stocks that we can put together a diversified portfolio that also has reasonable liquidity. We then distilled those select group of strategies that have performed well over the long term, and we focus on 4 methodologies that use a diverse set of selection criteria. And we use these approaches to build a portfolio that's diversified based on investment style, as well as size or market capitalization, as well as sectors and industries. Over the years, the SSR portfolio has evolved. When we first launched back in 2002, we actually had 60 stocks in the portfolio. and we almost immediately discovered that that was a little too unwieldy for a typical investor to track. So we pared that down to 36 and held that steady up until last year when we bumped it up to 40, just a nice round 10 stocks for each of the 4 methodologies that we track. So as I said earlier, there are 4 superstar gurus whose strategies we currently mimic to build the SSR portfolio. We have William O'Neill, David Dreman, Jim O'Shaughnessy, and John Neff. But it's important to point out that these individuals had in no way had any involvement in the development of these strategies. They've written books, they've written academic papers. So myself and different analysts at the association over the last 20 plus years have reviewed the writings or discussions of these methodologies, and we've distilled this information down, and we've developed our own methodologies that attempt to mimic these 4 superstars, as well as all of the other superstar strategies that we track at AAII.com. But we've never consulted with those individuals, nor have they have any involvement with that. These are our interpretations of these different strategies. So the first guru I'm going to talk about this evening is William O'Neill. O'Neill started his career in 1958 as a stockbroker, and in his early years, he developed an investment strategy that eventually became known as CanSlim, that made use of early computers. And using that strategy, he actually became one of the top performing brokers at his firm. And he was actually so successful that at the age of 30, he bought a seat on the New York Stock Exchange and became the youngest person to do so at that time. In 1963, then he founded William O'Neill and Company, which developed the first computerized securities database. So he was really very much on the cutting edge of computer-aided investment screening and analysis. In 1984, he then made his research from his database available in print form and launched Investors Daily, which eventually became known as Investors Business Daily, or IBD, which coincidentally was actually recently acquired by News Corp. So CanSlim, you'll probably hear that William O'Neill and CanSlim used interchangeably tonight, but CanSlim is an acronym that O'Neill developed to help investors remember the 7 factors that he identified in the biggest stock market winners prior to their big stock price advancements. O'Neill discusses CanSlim approach in his best-selling book, How to Make Money in Stocks, which is now in its 4th edition. In addition, Matthew Galgani wrote a book, which is called How to Make Money in Stocks, Getting Started. And actually, I read this book as we were going through the refresh of SSR last year, and I found it to be an excellent supplement to O'Neill's book. So if you're interested in what you hear about this evening regarding CanSlim and the O'Neill approach, these 2 books, I think, would definitely be worth reading. But in Galgani's book, he emphasizes 3 big rocks that every CanSlim follower should remember. The first being only buy stocks when the market is in an uptrend. Second, focus on companies with big earnings growth and a new innovative product or service. And third and lastly, buy stocks that are being heavily bought by institutional investors. But for O'Neill and the CanSlim strategy, everything begins and ends with the trend in the overall market. So even though in the CanSlim, M is for market, even though that's the last of the acronym, it's actually really first and foremost when it comes to the CanSlim approach. Now, for those of you that have read my articles over the year or heard me speak, undoubtedly you've heard me probably say that I'm not really a firm believer in using market timing to make wholesale strategic portfolio moves. Namely because I don't think people are able to do it consistently over the long term. There are a lot of people out there that be able to say, I was able to call the last top or bottom or something like that. But it's very difficult, at least I've not run across anyone who's been able to identify market tops and bottoms consistently over many, many, many years. And ultimately too, market timing isn't a one-size-fits-all endeavor. If you're a value investor, I don't know if market timing adds much benefit to it. But I do firmly believe and use technical analysis, which I think does help investors make tactical timing decisions. John and I have friendly debates on this topic, but I do use technical analysis in my own analysis as well as to help manage the Group 1 O'Neill portfolio. And O'Neill uses charting and technical analysis when investing in these fast-moving, high-growth stocks, such as those that are unearthed by the CAN-SLIM approach. Galgani's Big Rock #1 states that we should only buy stocks in a market uptrend, and that we should take defensive action when the market begins a downturn. Now, to gauge the overall direction of the market, O'Neill follows intraday, daily, and weekly price charts of major market indexes, such as the S&P 500 and NASDAQ Composite. And to him, the trend truly is his friend. IBD research has shown that 3 out of 4 stocks go up when the market is in an uptrend, as well as 3 out of 4 go down when the market is declining. So it definitely pays to pay attention to what's going on in the overall market. O'Neill himself will only buy when the market is in a confirmed uptrend. He becomes more cautious when the uptrend comes under pressure, becoming much more selective in any stocks that he may buy, while also tightening his defensive stops. And when the market enters a correction phase or a downturn, this is when O'Neill starts paring his positions and no longer adds stocks to his portfolio. O'Neill's research of stock market winners shows that almost all of them were exhibiting strong earnings growth both on a quarterly and annual basis prior to the big price run-ups. This growth was supported by a new product or service, new industry trend, or new key management or team before the big price increase. The first 3 letters of CAN-SLIM deal with these elements. C, which stands for current quarterly EPS, specifically accelerating year-over-year growth in quarterly earnings. A for annual EPS, both in terms of growing annual earnings on a year-to-year basis, as well as strong annualized growth over the last 3 to 5 years. And then N for new company, product or service, industry trend, or management. And again, it's this newness, whatever that may be, that ultimately is going to spark interest in the company and sort of light the fuse on the rapid share price expansion. Galgani's Big Rock #3 focuses on demand for stocks by large investors who ultimately control the market and thus the fate of most individual stocks. These big investors include mutual funds, hedge funds, pension funds, and insurance companies. These are the so-called institutional investors. And tied to that then, we have S, supply and demand, which means looking for companies that have a relatively small numbers of shares outstanding. L, which stands for leader or laggard, which refers to investing in the strongest companies in the strongest industries, not also rans in strong industries or strong companies in subpar industries. And then lastly, I is for institutional sponsorship. And this means you're looking for stocks that have institutional investors that are taking larger and larger positions in the portfolio. And ideally, some of these might even be some of those quote unquote 5-star Morningstar mutual funds. So you're getting some good institutional interest in these stock. And this large demand, the large sums of money that flow into stocks through institutional investors, coupled with the relatively small number of shares outstanding for these companies that O'Neill looks for, the small supply and the large demand, law of supply and demand means that if that does happen, you'll normally see an explosive increase in stock price. Now, on the sell side, O'Neill uses fundamental factors to influence the stocks that he buys. But on the sell side, by and large, he uses charting and technical analysis to decide when to sell. He also uses charting on the buy side as well, but really when it comes to the sell discipline, it's very much tied to price activity and chart patterns. The closest he comes to mentioning a fundamental sell rule came in the second edition in his book, How to Make Money in Stocks. In there, O'Neill suggests consecutive quarters of slowing earnings growth could be a warning sign that the company is no longer in a high growth phase and it might be time to move on. However, O'Neill also believes that stock price will more quickly reflect deteriorating fundamentals than a company's quarterly earnings reports. And for this reason, O'Neill places a greater premium on price action when it comes to selling. He'd much rather buy and sell a high growth stock to lock in gains and to quickly sell stocks for minimal losses. He actually points out in his book, and it makes a lot of sense to me, that every 20 or 30% loss in a stock starts with just a smaller 7 or 8% stock loss, which is actually the stop loss that he often uses, a 7% or 8%. Now, the second featured superstar I'm going to talk about this evening is David Dreman, who's the founder and chairman of Dreman Value Management. Now, Dreman has been at the forefront of research that's become known as behavioral finance, and he studies the psychological underpinnings of the overall stock market and its impact on stock valuation levels. Now, instead of assuming a rational market, as many traditional academic studies do, Dreman sees stocks and markets as driven by emotions that are often pushing prices away from their intrinsic or quote-unquote true value. Dreman has written numerous academic papers on investor psychology, along with 5 books, including Contrarian Investment Strategies, The Psychology of Stock Market Success. This book and its subsequent editions served as the inspiration for the approach we use to manage the Group 2 SSR portfolio. Dreman feels that the best approach to beating the market over the long term is to follow the principles of contrarian, pardon me, to follow the principles of contrarian value investing. Contrarian investing involves betting against the crowd and selecting stocks that are out of favor with the market, as well as avoiding the fashionable high-profile stocks that have been caught up in the market euphoria. Interesting enough, when you look at the Canslem approach and the Dreman approach, they're actually very, very opposites. And that is one of the things we're trying to do with the overall SSR, is to find disparate approaches, knowing that no singular approach is going to perform well over the long term. So there might be periods of time when high growth and momentum might be performing well, and other times a more value-oriented approach such as Dreman. So, keep in mind when you see these, and it's like, wow, these are so different, that is what we're trying to achieve with the overall SSR approach. Dreman's approach relies in part on the concept of reversion to the mean, whereby eventually the market rediscovers the good qualities of these out-of-favor stocks, pushing their stock prices higher and letting the high flyers fall back to earth. Pardon me. So at the start, Dreman looks for low PE stocks that are still financially solid. In doing so, he hopes to find stocks with good prospects that have been oversold by the market due to some short-term issue. Dreman's research in behavioral finance led him to examine earnings estimates, and what he discovered isn't encouraging, at least from an accuracy standpoint. However, his research also uncovered an opportunity for contrarian investors. But first, let's consider why earnings estimates are so important. A company's ability to generate earnings is the long-term driver of stock prices. And for this reason, a great deal of emphasis is placed on earnings projections. However, to be truly valuable, these projections must be very accurate and go very far into the future. The market now sees earnings estimates as being so accurate that a miss of only a penny or two can lead to price declines of 5%, 10%, or even more. However, research by Dreman and others shows that analysts are highly inaccurate because they are subjected to the same psychological biases as investors. And according to Dreman, the difference between analyst estimates and actual reported earnings has averaged 40% a quarter over the last 30 plus years. So if that research is accurate, definitely analysts don't do a very good job of forecasting forward earnings. Part of that reason is analysts use sophisticated models to forecast earnings, which are based on increasing amounts of financial data. However, there is no correlation between the sophistication of a model and its accuracy. In fact, there may actually be a negative correlation. So this ties back into what John and I were talking about earlier, is sort of the old keep it simple, the KISS methodology. These analyst models are actually built on quicksand, in Dreman's opinion, relying too much on factors that are difficult, if not impossible, to forecast reliably. Instead, the increased information and sophistication only serves to increase investor confidence, not accuracy. So these estimates actually are lulling investors into a false sense of security. Dreman feels that it's impossible to accurately forecast the future given the dynamic economy with its ever-changing political, economic, industrial, and company conditions. These forecasting errors, as it turns out though, can be used to an investor's advantage. An earnings surprise is when a company reports earnings that are above or below the consensus estimate. A positive earnings surprise occurs when a company beats a consensus estimate, while a negative surprise takes place when the company reports earnings that fall short of the analyst projection. By investing in out-of-favor stocks, Dreman believes that investors can take advantage of the high rate of analyst forecast error. His research found that in stocks with low price earnings react more strongly to positive earnings surprises than did high PE stocks. As it turns out, a positive earnings surprise for a stock with high expectations, as measured by a high PE, is merely a reinforcing event and not an actual surprise. So if a company has high expectations, you would expect it to keep meeting those high expectations. So it's like, okay, it's doing what it's supposed to be doing. However, positive earnings surprises for out-of-favor stocks are seen by the market as what Dreman calls event triggers. These event triggers initiate a perceptual change among investors, which can push stock prices higher. So it's sort of, you're not expecting anything out of this particular stock, and all of a sudden it starts stringing together a bunch of earnings surprises, and the market's like, ooh, maybe we were wrong. And the market will jump on and push that stock back to that, again, that reversion to the mean, and push the stock price back to that real or true value. The impact of negative earnings surprises, on the other hand, is reversed. Out-of-favor stocks that have negative earnings surprises are really just confirming expectations. So these are reinforcing events that don't lead to any significant reevaluations. So it's not surprising to see a low PE stock to have a negative earnings surprise and the stock price not move very much, if at all. However, for highly valued stocks or those with high PEs, a negative surprise is a trigger event that usually leads to a sharp downturn in the overall valuation as analysts reevaluate the company's prospects and its stock price. So, a high flying stock with a very high PE, if it even just matches earnings, the consensus, or misses by just a penny or two, it's not surprising to see the stock price go down, 5, 10, 15% shortly in a short period after that earnings announcement. The resulting change in stock price due to these trigger events is often immediate, but there are long-term effects as well. Studies indicate that the effect can persist for as long as a year after the announcement. This means it may not be too late to buy an out-of-favor company weeks or even months after it reports a positive earnings surprise. It also means, though, that it may not be prudent to buy an immediate decline following a negative earnings surprise for a high PE stock. Studies also reveal that revisions in earnings estimates lead to price adjustments very similar to those of earnings surprises. When analysts revise their estimates significantly upward, perhaps as much as 5%, stocks do tend to show above average price performance, especially among low PE stocks, while stocks with downward revisions tend to show below average performance following the adjustment, especially for high PE stocks. Beyond the rules to help investors overcome their behavioral biases, Dreman has been quite explicit when outlining his contrarian value approach for selecting stocks. First and foremost, he focuses on large companies, and this is because these companies tend to have a greater chance for a rebound if the company takes a misstep. There's also a reduced chance of quote-unquote accounting gimmickry with larger companies, since the eyes of Wall Street are upon them. In addition, larger companies are less likely to fail. Dreman seeks value in terms of low price earnings ratios and high dividend yield. He won't overpay for companies that appear to be the best prospects, but he also doesn't necessarily shun those that appear to have the weakest prospects. He also looks for a foreseeable future stream of earnings, because again, it's those future earnings that are ultimately going to be driving the stock price. While Dreman doesn't place a lot of emphasis on fundamental analysis, he does feel it's important to consider the financial strength of a company, especially when following a contrarian value investment strategy. A strong financial position enables a company to work through an extended period of operating difficulty when often experienced by out-of-favor stocks. Overall, it's important to distinguish between a good company and a good investment. Good companies often see their stock prices bid up to dizzyingly high levels, while beaten down stocks of quality companies tend to be better long-term investments. Looking at the sell side of things, Dreman's primary sell rule is when the PE ratio rises above the level of the overall market, regardless of how favorable its future prospects appear. However, Dreman does differentiate between PE increases due to rising price and those stemming from a decline in earnings. Stocks with a rising PE due to declining earnings should not be sold, assuming that this downturn in earnings is only a temporary situation. Dreman also follows a 2-year holding period rule when it comes to evaluating price performance. If a stock has not done as well as the market after holding it for 2 years, he simply moves on and replaces it with another low PE stock. Another caveat, though, is that Dreman will extend this holding period out to as far as 3 years for cyclical stocks experiencing a temporary decline in earnings. The next superstar I'll introduce this evening is Jim O'Shaughnessy's factor approach. And he's the founder and chief investment officer of O'Shaughnessy Asset Management. Jim is considered a fundamental quant. He has done a mountain of research because of that, he's been recognized as a pioneer in the field of quantitative analysis. Jim is also a friend of AAII, and actually in 2019, he was awarded the Clunan Award for Excellence in Investment Education. He's also written one of the best investment texts I've read, What Works on Wall Street, which is now in its 4th edition. And a lot of the research that he outlined in that book went into the development of the methodology and the strategy that we follow for the Group 3 SSR portfolio. But if you pick up any of the 4 editions of Jim's book, What Works on Wall Street, you're going to find a common thread that runs through all of them. As a quant, Jim has spent his career analyzing stock characteristics to see which of these characteristics are most profitable when it comes to selecting stocks. These characteristics have today become known as factors. By some counts today, there are as many as thousands of different factors that investors and money managers use to identify promising stocks. But probably those factors that most of you are probably most familiar with are value, quality, financial strength, growth, and momentum. Jim O'Shaughnessy is a strong advocate of value investing, and much of his research revolves around identifying those value factors that have been most valuable and profitable when selecting winning stocks. Now, in previous editions of his books, he was very much focusing on individual factors. He would look at price to book, price to sales, PE ratio, dividend yield, etc. But actually, he admits that probably one of the biggest investment mistakes that he's made in his entire career is when in the first 3 editions of What Works on Wall Street, he put basically all his eggs in the price to sales basket. He labeled that to be the king value factor. But the research that he did for the 4th edition of What Works on Wall Street, he actually pivoted and decided that it was actually best to combine different factors together into quote unquote composites. That's because while discipline is a key to successful investing, flexibility is also very important. And O'Shaughnessy has shown that he's willing to evolve as an investor. And he uncovered that you're able to, by combining multiple factors into a composite, these composites yield better, more consistent, and less volatile results than relying solely on one factor. So he created several composites that address a stock's valuation, financial strength, and earnings quality. And these 3 factors serve as the cornerstone of the Group 3 SSR portfolio. So the first composite O'Shaughnessy came up with was a value composite. And with that, he combined the rankings of 5 popular value measures: price to sales, PE ratio, enterprise value to EBITDA, price to free cash flow, as well as shareholder yield, which is dividend yield, plus the rate of share repurchases. For our own AAII value composite, we actually added in the price to book ratio as well. And again, by combining these different factors into a single composite, very much like I mentioned that a given investment strategy might perform well relative to another over differing market conditions, where some styles will fall into and out of favor. Jim O'Shaughnessy's research showed that individual factors actually fall into and out of favor as well. So instead of looking for following a singular investment element, such as the price to sales ratio, you can combine them into a composite, and it might smooth things out. So the highs might not be as high, but the lows won't be as low either, and allow you to capture a greater and a more consistent value, measure of value over the long term. Now, as a long-term investor, I recognize the fact that many stocks deserve to trade with rock bottom valuations. And this is why I advocate adding qualifying elements to any approach that looks for deep value stocks. O'Shaughnessy too realizes this, and he understands the importance of selecting quality companies that are trading at attractive valuations. And this is why he also then created Composites to look look at the company's earnings quality as well as financial strength. And he uses these more as exclusionary filters, basically using these composites to identify stocks that you shouldn't own. So for the earnings quality composite that he came up with, he used 4 different factors, current accruals to total assets, change in operating assets, total accruals to total assets, depreciation to capital expenditures. But he found, being a pragmatist, he understood that probably for the average investor, a lot of people aren't familiar with these terms. Where do you find this information, etc. So that's why when he was actually writing an article based on his research for the AAII journal, he created an alternative measure of earnings quality, which examines the difference between a company's cash from operations and its net income over the trailing 12 months. Basically, this looks at the accruals that a company is using. And the closer a company's operating cash flow is to its net income, the smaller the ratio. And this means that a company is using less accruals, which are adjustments to net income that reflect the accounting assumptions made by management. This in turn, having a smaller number of accruals, means that the company is using a more conservative accounting approach, which is an indicator of higher quality. Then lastly, when you're look at financial strength, O'Shaughnessy created a composite that also looks at 4 factors: long-term debt to equity, cash flow to long-term debt, external financing, as well as the 1-year change in long-term debt. And what he's looking for ultimately here is whether or not a company is able to generate enough cash flow to satisfy its debt obligations, as well as looking at the extent to which a company is relying on external financing. Ideally, a company is financing itself through its organically generated cash flow. But if a company does have to look to external sources of funding, takes on debt, then it's very important that the company is able to meet those obligations. And that's what the financial strength composite that O'Shaughnessy created evaluates or ranks. So at the end of the day, we have the value, earnings quality, and financial strength composites. And for the SSR portfolio, the initial group of candidates, very simple. We're looking for stocks that rank in the top 20% in terms of attractive valuation, earnings quality, and financial strength. So very, very simple, straightforward strategy for identifying stocks for the Group 3 portfolio. And then the last stock superstar we talk about this evening is John Neff, who is the former manager of the Vanguard Windsor Fund. Neff passed away in 2019, and at the time, some people called him the last star mutual fund manager. And when you look at his performance while he was the manager of the Windsor Fund, you can understand why. Over his 31-year tenure from 1964 through 1995, Neff outperformed the S&P 500 in 23 of those years. And over that 10 years, he bested the S&P 500 by almost 250 percentage points, or by more than 300 basis points a year. He actually, in his retirement, wrote a book, Neff on Investing, which is another very classic, highly recommended investment text. Not only does it offer a tangible selection criteria that Neff and his team used when they were managing the Windsor Fund, but it also offers a very telling trading journal of Neff's career, discussing both the challenges as well as the successes that he faced over 30 years of market ups and downs. And that book, Neff on Investing, serves as the basis for the Neff strategy that we use to manage the Group 4 portfolio. Now, Neff was called a contrarian investor, but he seemed to shy away from that designation. He was quick to point out that investors shouldn't bask in the warmth of just being different. He warned that there was a very thin line between being a contrarian and being just plain stubborn. Neff preferred to be called a low PE investor. However, as I've mentioned multiple times this evening, many low PE stocks have poor prospects, thus they deserve that low PE. And for this reason, Neff also looked for stocks exhibiting elements of fundamental growth as well as strength. Neff focused on the PE ratio because he felt there was no better yardstick for comparing stocks. In effect, the price-earnings ratio expresses the stock price per dollar of earnings a company generates. It also is a measure of the market's expectations for a stock. The higher the PE, the higher your expectations, the higher perceived prospects. The lower the PE, the lower the prospects, the lower the expectations the market has for the stock. But because many low valuation stocks deserve that, Neff favored low PE stocks showing reasonable growth rates. The reason being that even low growth may indicate better prospects than the current valuation reflects. High growth rates often fuel high PEs, but as these growth rates revert back to the norm, PEs also tend to fall back to earth. Absent stunning growth rates, low PE stocks can capture the wonders of PE expansion with less risk than skittish growth stocks. So to that end, Neff and his team tended to focus on low PE stocks with both sales and earnings growth of roughly 7% to 20% a year. Neff was also a strong advocate of dividend-paying stocks. Oftentimes, low PE stocks also carry with them relatively high dividend yields. Now, only time will tell if earnings and growth rates will meet expectations. But while you wait, you'll enjoy the dividend, which is all but certain, because except in extraordinary situations, a company is very unwilling to cut or suspend its dividend. When a company raises a dividend, Neff calls this a free plus, which is the return you can enjoy as a shareholder over and above the initial expectations. You're over and above your initial expectations. However, Neff and his team didn't automatically require a company pay a dividend, but they did require a higher growth rate for that lack of dividend to compensate for that lack of yield, perhaps growth as high as 12% to 15% annually. When picking stocks for the Windsor Fund, Neff followed what he called a total return strategy. And for him, total return described his growth expectations, which he measured as annual earnings growth plus dividend yield. In effect, total return represents what you get when you buy a share of stock. Neff used a total return ratio, which is the ratio of total return, which again is the sum of the earnings growth rate plus the yield, to the PE ratio. Now, the PE ratios measure what you pay to secure the total return. Neff and his team look for stocks with a quote-unquote cheapo profile, whereby their total return to PE ratio exceeded the market average by 2 to 1. To put it differently, and if you look at the inverse of the relationship, stocks that Neff preferred were trading at discounts of up to half the going price for growth. Neff was also aware that companies have much leeway when it comes to reporting earnings. This was especially true during the dot-com era, when companies kept pushing up farther and farther up the income statement to identify, some variation on quote-unquote earnings to make them look profitable. For this reason, Neff preferred to look at the company's cash flow instead of what's going on in the income statement. And he measured cash flow as retained earnings or net profits, not distributed through dividends and other means, plus the depreciation expense. Neff ultimately was looking for companies generating excess cash flow, which could be used for additional dividends, sharebacks, acquisitions, and reinvestment. The final fundamental measure that Neff mentioned in his book was operating margin. And this ratio highlights the relationship between sales and operating income, which is what's left over after the costs related to sales are deducted from sales. Margins do tend to be highly industry specific. So it's very important that if you are looking at margins and looking at different companies, that you're comparing the margins of companies in the same line of business or sector or industry. Otherwise, the relationship has no real meaning to it. Technology and biotech firms tend to command the highest operating margins, while retailers often operate with razor-thin margins. Neff used the operating margin as a measure of a company's margin of error against unforeseen events or shocks. For him, a robust operating margin within the framework of a low PE strategy offered protection against negative surprises. Now, when it comes to selling for Neff, it really came down to two elements: the fundamentals and the projected price based on the expectations for earnings. Neff never had a problem selling when it became apparent that he made a mistake regarding a company's prospects. He was probably one of the lowest ego investors that I've ever read about. He was very self-deprecating. He was very modest, and he realized that he wasn't perfect. And when he identified the fact that he made a mistake, he would move on, and tomorrow was another day. And to make this judgment whether or not he'd made a mistake, he looked at the estimates of earnings and 5-year growth rates. He also cautioned about falling in love with a stock. To him, every stock he owned was always for sale. And in his book, he cautioned that when you feel like bragging about a stock that you own, it's probably time to sell. So this concludes my overview of the 4 strategies we use for the Stock Superstars report. Now I want to spend the remainder of my time this evening walking you through the SSR service as well as the website. So this is what the SSR portfolio offers. The SSR portfolio is a 40 stock portfolio comprised of 4 10 stock portfolios, each following a different stock superstar. So the SSR portfolio as a whole may appeal to a variety of investment styles. You have a high growth and strong price momentum strategy from William O'Neill. You have a strategy that looks for large cap, dividend paying, deep value companies that are exhibiting positive earnings surprises as well as upward earning revisions, and that's from David Dreman. You have O'Shaughnessy's factor-based approach that uses factors that identify companies that have attractive value, strong financial strength, as well as earnings quality. And then you have Neff's deep value with fundamental growth approach. So you have the 40 stock portfolio. Then on a weekly basis, you receive email alerts with commentary from yours truly, as well as meaningful news items on the portfolio holdings. We also then have a monthly newsletter where we will discuss any changes to the portfolio, whether any stocks are being added or removed from the portfolio, as well as information on the individual portfolios, as well as a monthly education article that I write as well pertaining to some aspect of analysis with a tie-in to the SSR portfolio. And then as well, you also have a dedicated website. Now, the true success of any portfolio is its performance relative to a meaningful benchmark. And inevitably, we'll get the question. So I have this slide here that shows you the performance of the SSR portfolio, as well as the individual portfolio groups. Now, the SSR portfolio has outperformed the IYY, which is the iShares Dow Jones US Index ETF, since its inception of 2002, net of fees. But what I find more interesting and perhaps makes me happier is the fact that the 4 individual portfolio groups that have been added, that the strategies have been added to the portfolio over differing time periods. Since each of the 4 methodologies have been added to the portfolio, they've all outperformed the benchmark IYY ETF by a much greater margin over the time period that they've been in existence. So that's what I find personally a great satisfaction in. So now I'm going to cross my fingers. There's always the risk when you go live, but I'm going to switch over to my web browser and give you a guided tour of the resources available. But this might take me just a moment or two. John, do we have any questions that I might answer while we're getting this up and running?
Certainly. Let me pull up a question here. So I am a lifetime member of AAII. One of the many ways to trade, I have been learning how to trade options. How can I use the information in terms of recommendations from these services to pick stocks or trade options?
Well, I fully admit we don't do much when it comes to options at the association. So if you are looking for option related strategies, that is something we probably won't be able to help you much with. But if you're looking for stock ideas, we have a whole wealth of them. Just as a member of AAII, you have access to the 60 different stock screening strategies that we produce monthly passing companies list for. Actually, I'm sorry, daily passing companies list for. But if you're looking for more vetted, more vetted, more directed information on how to manage a stock of portfolios, we have our model shadow stock portfolio, we have the stock superstars report, and then we also have VMQ stocks and our dividend investing portfolio.
Sure. Kind of almost a follow-up to what you were saying there. And I'm sorry if I'm distracting you from pulling up your web browser here, but
not at all.
AAII tracks many strategies on its website. How do these four make it into the service? And then as a follow-up from another member is you have screens that show these strategies. How different are the strategies that you have in this SSR service versus what members can see online? So two questions there. How do we pick the four? And then how do these four differ from what members can get online?
So the four that we initially started with, where we took the data that we had on the stock screening strategies that we're tracking back in 2002, and looking at the performance data of these, and finding a select group of strategies that performed well over differing time periods. Then we took those strategies that were the sort of the top performers, and then we did some analysis to see, how well they or how differently they performed relative to each other. So we look for strategies that have a relatively low correlation to each other. So that means that one strategy might be performing very well, while one or two others might be performing relatively, quote unquote, poorly. But then, as the market enters a new phase, different economic cycles, different market cycles, then the one strategies that might have underperformed for a period of time, they become more strong, and the ones that have been performing well might starting to lag. So it sort of smooths things out over the long term, but it's finding those strategies that are good long-term performers, as well as having a relatively low correlation with each other. But then we have replaced strategies over time, and that just comes down to looking at relative performance, as well as turnover. If we identified a strategy that was not performing overly well and generating a great amount of turnover, which can be detrimental to a portfolio, those were typically the two driving factors when we did end up moving on from a different strategy. As far as then the four strategies that we currently use, how much they differ from the online screens that we have, they are very close. We do make some changes, but the biggest element is having elements of liquidity that are required as well. So as we put these buy and sell alerts, addition and deletion alerts out there to our subscribers, we want to make sure that there's sufficient liquidity so that their buying and selling doesn't have too significant of an impact on the stock price.
Well, I'll let you go ahead, continue with your presentation. I'll be looking for additional questions, and I see more questions coming up, so we'll be sure to get to those before the evening's up.
Great. Just can you see the SSR page, John?
I can see the website, yes.
Excellent. So this is the SSR website. Part of our refresh last year was a completely redesigned website, and I can't give nearly enough credit to both our technology team as well as our artistic team in putting together what I think is a very clean, very, very pleasant viewing experience. But here you have the SSR portfolio. You always have, let me, if I can find it again. Oh, nope, because I lost it. So I don't have a pointer that I can easily, let's see here, there we go. So you'll find each week I write a commentary regarding things that are happening in the portfolio, things that are happening in the market. I do a ton of reading, visit a number of websites. So every once in a while I'll find a investment topic that might be tied in some way to some analysis I could do for the SSR website portfolio. So you have my latest commentary. You'll have a performance chart showing you the long-term performance of not over the portfolio, but the individual portfolio groups. You also have then select portfolio performance data. You can also then find, and then you can see recent portfolio activity. So you can come here immediately to see the latest additions and deletions that we've made to the portfolio. From there, then, you can see the overall portfolio. So all of the holdings that we currently have in the portfolio. Actually, currently, we try to hold 40 stocks. Currently, we hold 39. We removed a stock from the Group 1 portfolio at the end of May. But with the market being in an uptrend under pressure, I held off on adding a new stock until the market entered a confirmed uptrend. But here you can find all of the latest holdings lumped together. But then we also have the individual pages dedicated, sections dedicated to the individual gurus. And in each case, you'll be able to find the portfolio holdings for each of these four sub-portfolios. So you'll find current holdings, performance data relative to those holdings since they were added to the portfolio. We then have a portfolio analysis tab that has selected data points that are specific to that given methodology or strategy. So for example, with the Cancelum approach, very much price momentum oriented, as well as earnings growth, quarterly, annually, as well as year over year growth. So you have these different portfolio analysis tabs for each of the four strategies. Also, when we did the refresh for the SSR portfolio last year, I also came up with portfolio watch lists for each of the four groups. So you have the 10 stocks that are in each of the four portfolio groups, but we also then have a portfolio watch list that serves two purposes. One, it provides additional ideas if someone isn't interested in the stocks that are currently held in the four portfolio groups, but also then this serves as a feeder for me. These are stocks that I've already screened upon, done some initial vetting on. So if I do remove a stock from a given portfolio group, I automatically have stocks that have already gone through some vetting that I can potentially choose from when I have to replace a stock. Each week, as I alluded to, if you go under the latest section, we have an archive of my weekly commentary. We also then have a compilation of the monthly Portfolio Corner articles that appear in the monthly newsletter. So this past month, I wrote about market breadth and how people could use that to evaluate the overall market, as well as their individual portfolios. On a monthly basis, if you subscribe and get the mail newsletter, then through the mail, you would get the monthly SSR newsletter. It's also available and downloadable via PDF. And we have every single monthly PDF dating back to 2003 But here you can download then the full PDF. And again, kudos to our editorial team for the, I think, a beautiful newsletter design that they put together. But it, market commentary written by myself, in-depth discussions of any portfolio additions or deletions that might have been done, news on stocks in the pertinent news for stocks in each of the 4 portfolio groups, as well as then that portfolio corner that is more of an educational oriented article based on some elements of the strategies that we use, some analysis technique or something like that. Then also, was very cognizant of trying to offer as much onboarding material for new subscribers. So as a new subscriber, if you sign up, you have access to an in-depth user guide. Covers how to how to build your initial portfolio, how you manage your portfolio, things like that. We have FAQs, we have a glossary, there's an overview of the SSR strategy. But perhaps of most interest to a lot of people, especially if you're new to the Stock Superstars report, and one thing that we've really jumped into with our webinar Wednesdays, but starting March, April of last year with COVID and not having face-to-face meetings, we really jumped into online events. And so we started doing a lot of webinars. And over a course of 4 different webinars last fall, I actually had a webinar devoted to each of the 4 gurus and strategies that we use for the SSR portfolio. And actually in the slide deck that you can download, I have links to these 4 strategies as well. So that in and of itself is a sort of a brief overview of the strategy of the SSR approach. But before I turn things back to John to start taking additional questions, I do want to, let's see here. So here, slide 72 are the direct links to the 4 webinars that I put on related to the 4 individual strategies. So you can use those links to access those presentations directly. You don't have to be an SSR subscriber. But lastly, before I turn things over to John, for people attending this evening, to show our appreciation, any first-time subscribers to the Stock Superstars report, we're offering a special offer, a 1-year subscription for $97, which is 61% off the initial price, a 3-year subscription for only $195. Or if you're really interested, we offer now our AAII Platinum service, which includes all of our premium portfolios, SSR, MQ stocks, and dividend investing, as well as AAII's new A+ Investor discovery, analysis, and tracking service. And so if you go to the URL at the top of this slide, https://invest.ai.com/SSR-member-sale, you'll be able to participate in this special offer. But before I start choking and get a drink, I'm going to put this slide up. But John, I will turn it over to you again to start taking some questions. But thank you, everyone, for your time.
Great presentation, Wayne. And I'll answer this first one while you're taking your drink, because I think I can answer it. The question here is, what software does my computer need to access all of these different tools? Do I only need a browser, or do I need to download some software that runs under Windows OS?
Browser only. All of our premium portfolios and the A+ Investor service are all web-based, so they are OS agnostic. So if you're a Mac user, if you're a Windows user, if you're accessing this, we're doing a push now to make these services mobile friendly, mobile responsive. So even on your phone or a tablet or something like that, you can access them. You don't need any additional software.
So I've got a question here regarding the David Dreman strategy. And what would David Dreman say to do with earnings forecasts for a medium value company, i.e. PE is kind of in the mid-range. It's not expensive, it's not cheap. Does a surprise mean much for that kind of company?
I mean, his analysis by and large showed that, it's things are magnified at the tails. So, a positive earnings surprise for a very low PE stock or a negative earnings surprise for a very high PE stock tend to have the greatest impact. At the end of the day, it probably, if it's more of a middling, a lot of it probably has to do with visibility. So if it's, if there isn't a lot of clarity on the earnings, that could play into it. But yeah, it's his research definitely was tied more towards the extremes and being able to capitalize, and that's why he looked at those very low PE stocks.
So they probably don't react as it being either a confirming information or a surprise. It's sort of a just they react, I guess, if there's a big discrepancy from the surprise, but not they don't really. There's no built-in expectation of either outperforming or underperforming.
That's correct. Yeah. At the end of the day, it's probably the level of significance. Sort of you follow SUSCOR or something like that. It's the level of significance of the surprise when you're looking at companies like that.
That's great. In terms of O'Shaughnessy, what is the exit plan within that particular approach?
So it's basically looking at. So we're looking for stocks that are in the top 20% for valuation, earnings strength, and earnings quality and financial strength. Then we're looking for the primary sell is going to be valuation. So if the valuation creeps into the top 20% of the stock universe, that would be an automatic sale. We're then also looking for a significant deterioration in both earnings quality and financial strength. So we've got a couple of companies that are nearing either have fallen significantly based on earnings quality or financial strength, but not both. So we haven't that portfolio has relatively low turnover. We actually just sold a stock from that portfolio last month, but that I think was probably one of the first trades we'd done in that portfolio in quite some time.
I've got a member here who is taking a trial of both VMQ and SSR, and he notes that there isn't any overlap between the two different portfolios. Why is that? Was his question.
Well, mainly it's if you're buying two different services and you find significant overlap, sort of diminishes the value of the service. I personally although I did make one mistake recently with Sleep Number, I actually make a conscious decision when I'm picking stocks to not have any overlap. Try to come up with a unique set of companies for subscribers to look at. Charles and Derek, they're not as they don't pay attention to that. It doesn't bother them. That's a personal portfolio manager choice. But yeah, for me, it's if you're subscribing to this service, you want to get stocks that are all unique. If you're looking to see the overlap as confirmation, then I can understand where that potentially would be a disappointment. But again, I'm making that conscious effort to have a unique set of companies for this newsletter.
And in terms of, I guess you could ask this question here is, what is the advantage of SSR over A+ or VMQ services offered by AAII? Yeah, being offered by you.
Well, A+ is more for a do-it-yourselfer. So that is, you get access to our screening capabilities on both for stocks, mutual funds, and ETFs. So it allows you to discover investment ideas across a number of investment types. You then have the tools to evaluate these stocks, mutual funds, and ETFs to decide if you found a potential opportunity. But we offer them the tools to come to an informed decision about whether or not these are stocks, mutual funds, or ETFs that you either want to add to your portfolio, or if you already own them, whether it's time to move on from them, as well as the My Portfolio tracking aspect. So it also offers that portfolio tracking. SSR and VMQ are more for the people looking for directed information. So, specific stocks to add to their portfolio, monitoring them when it's time to remove them. As far as the overall strategies themselves, the VMQ stocks looks for stocks at the intersection of low value, high quality, and strong price momentum. So it is somewhat factor based. So you could see maybe some overlap as far as this strategy between like the group 3 and the overall VMQ. But even with the group 3, we're not using any type of momentum. But by and large, they're very disparate selection strategies are used for the SSR relative to what you're seeing with VMQ. So I believe we are using factors for group 3, and VMQ is basically entirely factor driven. The overlap as far as the strategies is almost non-existent.
Thank you. The O'Shaughnessy performance chart on the home page starts in April 2020, but some of the holdings go back to 2014. What's the explanation for this?
The explanation is, so in May, April 30th of last year is when the first time we shifted to start selecting stocks using our new O'Shaughnessy strategy. But we did not then jettison the stocks that were acquired previously using the old methodology for group 3. So yes, you will find that some of the holdings do date prior to that. Good or bad, in my mind, I wanted to sort of create that specific break or that specific starting point when we started using this new methodology. And I hope we do a good enough job of explaining the fact that the performance marks when we started using the O'Shaughnessy approach. That's interesting.
Still see you, Wayne. You're good.
When we started using the O'Shaughnessy approach to select stocks. And so that's when I started May 1st of last year as the starting point. But yes, the overall portfolio performance of group 3 does encompass some stocks that were selected using a different strategy. So that was my trying to create that line of demarcation, but it potentially could create some confusion, but hopefully that explains the rationale.
Do you follow, let's see here, I'm sorry. Do any of these strategies use trailing stops or stop losses?
The group 1 approach doesn't use explicit trailing stops, but very much, we rarely will sell based on price unless there's an unfortunate very large loss in any of the groups. But the group 1 strategy actually has very explicit, sell rules when it comes to decline from high and things like that. So we very much pay very close attention to price activity for the group 1 strategy, and have we don't have explicit sell rules based on if it's 7% we sell it, but we definitely keep the stocks in that group on a much tighter leash, and are willing to move on from stocks if we with losses that we would find quote unquote more acceptable in our other portfolio groups.
And I've got 2 questions that are sort of related, but they're stated differently. How would one go about investing in the 40 stock portfolio, all at once or through a gradual entry?
If you have, a 40 stock portfolio, fully recognize is a very large portfolio. I don't know of, I've been involved with SSR for 20 years. I've never maybe come across a handful of subscribers that have invested in either all 36 or all 40. So giving you the 40 stocks really allows you to pick and choose, really focus in on diversification. If you are going to invest in all 40, then I wouldn't buy them all at once. I would definitely start looking those that have been added most recently. Those ideally are still, things shouldn't have changed that much, where they more closely mimic the selection criteria that led them to be added in the first place. But then after that, if you are going to invest in all 40, then you could time your, it's ultimately, you buy it and it's very generic, but you want to try to ease yourself into the marketplace. But you can then look at the market activity. So try to buy on down days, sell on strong days, et cetera, et cetera. But again, if you are going to invest in all 40, more power to you. But that's something you really will want to ponder, even if you are getting the alerts on when to add or delete stocks. That is still a pretty large portfolio to manage.
But if you do manage if you go invest in all 40, you would basically, let's say you're going to invest $100,000, you would divide it by 40, and that would be the
yes.
dollar amount you'd put into each stock then?
Exactly. Whether you invest in 20 or 40, at the end of the day, yes. And thank you, John, for pulling me back in. It's equal dollar amounts amongst the 4 portfolio groups. So yeah, if you have $100,000, then you'd want to divide that. So invest $25,000 in each of the 4 portfolio groups, and then at the individual portfolio group level, it's investing equal dollar amounts in the individual stocks as well. So you want to invest equal dollar amounts. So no matter how many stocks you invest in, you at least start out with that equal allocation. So no one stock has an outsized impact right off the bat.
Yeah, and it's always kind of fun to have disagreement or different viewpoints, because Wayne and I, we agree on many things. Occasionally we disagree. But one of the nice things that's happened now, especially with zero commissions, and a lot of services do track your cost basis for you. The penalty today for investing in 40 stocks is not as great as it used to be years ago. It's pretty easy to go ahead, and you can even do fractional share purchases. So if you do want to follow all 40, it's not that bad. Again, it's because of the zero commission thing. Obviously, you don't want to, and the turnover isn't too great on these strategies, from what I recall. So it's not that bad. But again, it's a question of what you feel comfortable doing. And then I guess the follow-up question I have from another member here is, if he runs this as a 4x4 portfolio, which I think he means all 4 strategies, 4 stocks from each strategy, what's the best way to make sure he's being not too concentrated or diversified?
If you're investing equal dollar amounts amongst the 4 different strategies, you've already achieved a pretty good level of diversification on a style basis, because these are pretty disparate selection strategies. From there, though, I would definitely pay attention to your industry and sector concentration. And so I would say that was probably the biggest thing when you are looking at these across different groups and looking at individual stocks, is trying to maintain a proper or a sufficient diversification among sectors and industries. If you are really pay attention to size diversification, the stocks in the portfolio do run a pretty wide range of small cap to mega cap. So if you want to achieve, try to hit the trifecta as far as style, sector, industry, and size, then you might want to pay attention and try to diversify your holdings by market cap as well.
And what do you do with the dividends?
The dividends are swept into cash. We now track, we hold, used to be, we would have a cash balance for the overall SSR portfolio that then we would use to allocate when we're making additions and making new additions. Now we are actually paying attention to the cash balance amongst the 4 individual groups, and that is then used when we are buying new stocks for a given group, that those dividend income is then devoted to the new additions. We don't reinvest them in the classic sense. but they are being invested when we make new additions to the portfolio.
Very good. And then a member was asking in terms of the financial strength, if you could define it just quick. Is it the same for all 4 strategies? Does it differ strategy to strategy based upon the guru?
Financial strength.
Correct.
Well, we don't. Well, we only use financial strength. When we talk about financial strength, in most words, it's a concept. For Group 3, there's an actual financial strength composite score that we use to evaluate. But when you're looking at financial strength in terms of the NEF approach, it's sufficient growth in sales and earnings, free cash generation, as well as operating margin. So
Okay.
with Group 3, there's a specific financial strength factor, but the others is just the concept and looking for companies that are exhibiting elements of financial strength, with that definition differing depending on the guru.
And I know we're running late on time. We've got room for a few more questions here. One good question here is, within the website, when you list the 10 stocks for a given strategy, you could rank them on different ways. Is there any way that you think it makes sense to rank any given strategy by, so someone can pick four stocks from a given approach?
Group 1 would definitely probably be either relative strength or percentage of 52-week high. Group 2, the Dreman, would probably be PE ratio, so looking at the lowest PE ratio stocks. Group 3, probably start with valuation. That's going to be the biggest one. But then, if you're looking a low valuation, but finding that the financial strength or earnings quality are well below the 80th percentile, it might look elsewhere. And then lastly, for Group 4, it would be definitely the dividend adjusted PEG ratio, which is that total return ratio that I talked about. And you're looking for a lower PEG ratio is more attractive.
I've got 2 questions here, kind of similar. Do any of the strategies follow business cycles, and how nimble is the approach when it comes to a downturn?
We are. Well, let's start with the second question first. Outside of Group 1, and I actually made a conscious change of that. Historically, the SSR portfolio has been 100% invested at all times. So we wrote it up, we would write it down. Group 1, rereading O'Neill's books and whatnot, and seeing what a high premium he placed on market, on momentum and market direction. We do now. We had a point where if the market makes a downturn and we start selling off stocks, we won't be adding. I won't be adding stocks until this market enters an uptrend. So if we have a significant enough downturn, God forbid, there could be a possibility of us holding very few stocks in Group 1, but being full invested in the other 3 strategies. So we try to be, using price analysis, charting analysis, trying to be as nimble as possible. But I don't, and I alluded to that market timing isn't a one-size-fits-all approach, where I wouldn't use market timing for a value-oriented approach. That's it's the downs. Sometimes the downs are significant, but it's those downs. Especially if you're following a consistent investment approach, it's those declines that allow for the long-term outperformance as well. So hopefully that answers the question.
I believe so. And Wayne, this last question is optional to you. It was the first question that was asked tonight, but here you go. Do you believe we are in a melt up? And if so, when do you think the meltdown is coming? And that's Steve asked that question.
If it is a melt up, it's a pretty lukewarm melt up at this point in time. I definitely am waiting to see, looking at the charts for the CAN-SLIM approach. I mean, we've seen a couple of, at least once, and I think we're nearing another point where we're testing these all-time highs in the market. And so I'm curious to see, once we start getting close to that again, what's going to happen? Are we going to break through and continue on, or are we going to start keep bumping around? For those of you that are chart followers, you might have noticed that over the last several days, the range, the trading range on some of the major indexes has become very tight. And that normally, I always view that as sort of a wound spring, that things are really starting to spring, and whether it's going to spring to the upside or the downside, only time will tell.
Well, thank you very much, Wayne. Very informative webinar, and I had a couple of members also chime in that you did a great job with this, and they thanking you for doing the webinar. So thank you very much, Wayne. Have a good evening. I'm gonna check out and let our host here take us out.
Thank you, John. Thank you, Kyler.
Thank you both for a great presentation. I want to thank everyone who attended tonight's webinar. Links to some of the resources discussed tonight will be sent to your email address. We do have some upcoming webinars to highlight, which you can sign up for at www.aaii.com/webinars. I repeat, www.aaii.com/webinars. On June 9th, you can sign up for the Stock Splits Robo-Advisors and How to Use My Screens webinar at 7:30 p.m. Central Standard Time. Achieving Investing Success with the 5 PRISM Steps of Wealth Building Process Wednesday at June 16th at 7:30 Central Standard Time. You can also sign up for the Picking Right Investments First Cut Large Growth Funds and Convertibles on Wednesday, June 23rd at 7:30 p.m. and Unveiling AAII's Platinum Service on Wednesday, June 30th, 7:30. We wish all of you viewing good health and a great evening.